before we begin, I just want to share Montaka's basic formula for investing, and then you'll see as we step through the presentation, we're essentially just applying this framework. So, look, our formula for success is to identify large, reliable structural transformations that carry with them favourable economics, and then we seek to own businesses which are, in our view, high probability long-term winners in that space, if and when they're undervalued by the markets, of course. And so as you'll see today, we believe that LVMH satisfies these three criteria today. So let's get into it. Today, of course, I do want to talk to you about LVMH, the high-end luxury powerhouse, and I really want to make the case for why we believe LVMH is a high probability long-term winner, well positioned in a really attractive, structurally growing high-end luxury market, and that it's also undervalued today, thereby making it a great investment opportunity. I'll start just with some basics to get going, just for a couple of slides. So LVMH formed back in 1987. It's under the ticker MC over in France. Market cap just under 400 billion euros. Now, LVMH is essentially a holding company, if you like, or a portfolio of 75 branded houses or maisons, as they refer to them in France. These, of course, include well-known brands such as Louis Vuitton, Christian Dior, Fendi, Bulgari, Tiffany, and others. LVMH, well, has a built-out footprint all over the world, but importantly, its footprint over in China, the mainland, is also built out. So that's just worth keeping in mind as we step through this presentation. LVMH is also family-owned, controlled, and operated. The Arnault family, who I'm sure we're all familiar with, they own 49% of the shares in LVMH, and they actually have control over voting rights to the tune of about 64%. In terms of revenues, I've just by way of introduction, I've cut the revenues in two different ways just to lay out the business. First, by segment, and you can see there's 5 different segments there, ranging from wines and spirits, jewelry, cosmetics, selective retailing, which includes the likes of Sephora, so high experience retail, and then of course the big one, leather goods, which is by far the largest segment by revenue, accounting for about half the group's total revenue. By geography, look, the only point to note here is that this business is truly geographically diversified across the world's largest economies, with around a third of the business, well, about a quarter of the business coming from the US and Europe, and around a third of the business from China. Just building on the initial introduction, I just want to spend a couple of moments framing the different segments in LVMH, because not all of them are created equal, economically speaking, if you like. And what we'll see is that leather goods drives an outsized share of the group's overall economics, and this will be an important theme to keep in mind as we step through the rest of the presentation. So the chart showing shows on the vertical axis the operating profit margin of each of the 5 segments. On the horizontal axis, it's the 2-year CAGR revenue growth. So just think of it as the percent per annum that the business segment is growing at. And then the size of each of the bubbles represents the revenue, like the magnitude of the revenue of that segment. And so each of the 5 different segments are laid out. And what you can see is that big blue bubble for leather goods, it's not only the biggest segment, it's also the highest margin segment, and it's also one of the fastest growing segments. And to illustrate this point further, we show on this chart the share of the total group operating profit that has been delivered by the leather goods segment. And so this chart shows that, the leather goods segment increased its total contribution to total group operating profit from 55% back in 2016, and it's up at nearly 75% today. So it's a structurally increasing contribution to total group profit from this one segment, which is leather goods. And by the way, just to keep in the back of your mind, within leather goods, about 75% of that business comes from just two brands, which is Louis Vuitton and Christian Dior. So this business is really disproportionately driven by the Louis Vuitton brand and the Christian Dior brand. Okay, so here is a summary of our thesis as to why we believe LVMH is an undervalued long-term winner today. And there's really 5 pillars to our thesis, and we'll step through each of those briefly in the remainder of this presentation. So the first is that we believe that LVMH is an advantaged portfolio of monopoly-like assets. High net worth customers drive the bulk of LVMH's sales. High-end luxury markets grow structurally. LVMH's revenue growth is disproportionately driven by price and mix, and that has important implications for long-term profit margins. And that ultimately, at the end of the day, we think Mr. Market is underestimating LVMH's long-term earnings power and also therefore undervaluing today's earnings power. So let me step through each of these briefly. So the first is that LVMH's brands are monopoly-like assets. I've shown just a simple chart here that lists all the 75 branded houses within LVMH, and the date is the date next to each one is when they were founded, and you can see that some go back decades, some go back centuries. So these long histories of these businesses, the heritage that comes with these histories, combined with the decades of brand investment and nurturing that LVMH has deliberately undertaken very carefully, make each of these maisons monopoly-like assets in our view. Said another way, competitors simply cannot recreate these, no matter how much money they want to spend or how much time they want to spend. They're assets that really cannot be recreated. And of course, monopoly-like assets represent really nice barriers to entry for competitors. But there are several other dimensions to LVMH's business advantages too. So those include the fact that high-end, super high-end luxury goods, which is the space that LVMH plays in, are what's known as Veblen goods. That means that desirability and demand actually increases as price increases, which is unusual. There are subtle network effects in this business. The highest quality customers are the world's most desirable brand ambassadors. So the more LVMH sells to these ultra-wealthy customers, the more desirable the brands ultimately become to others. And there are several scale advantages in this business as well. The way the business is structured as kind of like a big holding company with 75 brands underneath, a little bit like a Berkshire Hathaway in some respects. There are scale advantages in procurement, sourcing, distribution, certainly in global marketing, particularly in the digital marketing space, as we know, which favors the world's largest customers who have the most data. And then also in other subtle ways, such as things like product testing. So, data on which product designs or shapes or colors which are trending in one brand can be shared to other brands to aid the design of future collections. So the second pillar to our thesis is that high net worth customers drive the bulk of LVMH's sales. Now, it's important to understand that LVMH's customer base is disproportionately exposed to high-end customers. And why this is important is that this group is relatively immune to the economic cycle. LVMH's customer base is also relatively less reliant on what they call aspirational customers. And of course, aspirational customers are not immune to the economic cycle and really do feel the pinch of inflation and high interest rates on the margin. So the way to visualize LVMH's customer base is as kind of like a power law distribution, which we're showing just to sort of illustrate on the chart on the left, where most of the group's revenues, especially in leather goods, stems from a relatively small group of ultra high net worth customers. And as I said, I mean, these high-end customers are essentially immune to the economic cycle. And you can see some quotes from the CFO just a few weeks ago. Quote, aspirational customers are under some form of pressure. Inflation is taking its toll. In fashion and leather, we've been experiencing improvement over the last few quarters, which obviously comes from less exposure to the aspirational customer. And he added that we see continuous strength from top-end customers. So to really put this into perspective, you can see over the last 3 years, for example, that difference between those with the really high-end customer base, such as an LVMH and an Hermes, versus those who are perhaps more exposed to the aspirational customer, such as, perhaps a Coach or a Kate Spade or even a Gucci. And so the chart that's showing is a revenue growth index chart, so just index at 100 3 years ago, and then just see what the organic revenue growth has done on an index representation as a comparison between those 5 different brands. And clearly an LVMH and an Hermes just stand out like a sore thumb, given their prized high-end customer base. The third pillar to our investment thesis is that high-end luxury markets grow structurally. So let's start with the total global luxury spend, which Bain estimates to be about 1.5 trillion euros each year today. And they see that growing to between 2 and 2.5 trillion globally in 2030. And so that represents a growth rate of somewhere between 4% and 8%. But what we'd add is some really important additional context that we think tells us something about the long-term growth potential of the high-end luxury subsegment in which LVMH plays. So first, luxury is very concentrated at the top end. Even out of the total global luxury spend, the top 5% of luxury clients across the board now account for approximately 40% of total sales. And that ratio is increasing. So, just a year ago it was 35. So that not only is the luxury space concentrated, but it's becoming more concentrated to the top end. Second, the number of people at the top end is also growing by about 4% per annum. And there are some stats that you can look up. This one's from Knight Frank, their annual wealth report that they produce each year. They said globally there's now 627,000 ultra high net worths, which are individuals with assets of at least 30 million US dollars. So that's growing at 4%. So sort of the volume of individuals, if you like, of ultra high net worths. But then, of course, the wealth of each individual is growing just because of capitalism and compounding. And that's a really important sort of aspect to this. And I think, perhaps points to Bain's forecasts ultimately being conservative in the fullness of time. So let's do a little thought experiment, if you like. So the chart on the left shows, and this is just in the United States, shows the total assets held by the top 1% in US dollar trillions. And obviously, a line that's going up a lot over time. And now what the chart on the right shows is the 5-year rolling change in the chart on the left. So by how much did the wealth increase for the top 1% over the last 5 years? And you can see that it's about $16 trillion. So the top 1% have increased their wealth by about 16 trillion over the last 5 years. Importantly, as you can see by that chart on the right, it's a number that seems to be increasing. So 20 years ago, maybe it was 3 trillion increase over 5 years. Now it's 16 trillion over 5 years. In the future, perhaps it's even higher. So, if the wealth of the top 1% is increasing over a 5-year period to the tune of about 16 trillion, and Bain is ultimately saying that, over the next 6 or 7 years, the total luxury market globally will increase by only 500 billion or at most 1 trillion. There's a little bit of a mismatch there. One could easily suspect that the luxury market actually grows much faster than that, in large part through price increases, because you can imagine that, even at the low end of that ultra high net worth figure of 30 million US dollars net worth for an individual, even if their net wealth is growing at only 5% per annum on average, I mean, that's an increase just to that individual each year of at least $1.5 million. And then in the context of, let's say, an expensive handbag increasing from $15,000 to $18,000 to $20,000, it's just not relevant in the context of the increase in wealth of that individual due to compounding. So we see upside risk to those long-term industry forecasts, especially in the high-end luxury space. Okay, the fourth pillar to our thesis, and here I want to return to the economics of LVMH itself. So LVMH's revenue growth is disproportionately driven by price and mix. And we think this is a really important point to understand. What's driving the growth of LVMH? Overwhelmingly, it's less about volume, it's less about stores. It's really a price mix story. So if we take a case study and we just pick, the biggest, most valuable, or most important brand within the LVMH group, which is Louis Vuitton, and if you look at the revenue growth of that business from 2020 to 2023, which is the chart on the left, so revenue growth increased by 82%. If you sort of decompose that into 3 components, the first being price mix, the second being store volumes, and then the third being stores, you can see that overwhelmingly the growth was driven by price mix. Works out to be about 80% of the total revenue growth has come from price mix. And then again, commentary from management just a few weeks ago, the CFO of LVMH spelt it out pretty clearly when he said, we're not trying to sell more volume here. We want higher added value. Now, the reason why we think this is such an important point is that price mix as a source of growth is by its very nature an unusually profitable source of growth. So if we focus on the chart on the left, this shows the group revenue of LVMH. 7 years ago, the group's revenue was coming in at an average operating profit margin of 19%. Since then, revenues have more than doubled, but the increment over and above 2016 levels of revenue, so that incremental revenue, shown in a sort of a different shade of pink on the chart, has come in at an average margin of 32%, so much higher. And this has largely been driven by really strong and profitable growth in leather goods. So recall that leather goods as a segment is one of the fastest growing segments, so it's a major contributor to the incremental growth of the overall group. And then if you look at the chart on the right, this shows what we call the incremental operating profit margins of each segment, which says, for each segment, for every dollar of additional revenue over and above where they are today, how much operating profit do they get to keep out of that additional dollar? And you can see that the incremental profit margin on leather goods is very, very high. It's up at like 44%. And the reason why it's so high in leather goods is because its growth is disproportionately driven by price and mix, as opposed to actually having to, produce more leather goods or open more stores, which all carry sort of higher incremental costs and therefore lower incremental margins. It's obviously much easier if you can essentially just price up what you're already selling. That comes with much, much higher incremental margins. It's a really nice business characteristic to exhibit. It's quite unusual. Okay, so let me now explain why we care so much about the incremental margins. And it's really because to us, they really hint where group margins will ultimately trend towards over time. So if I just step you through this chart, what we have here is the LVMH group operating profit margin. I'll start with the sort of the solid navy blue line at the bottom. That is just the group profit margin, which has increased from, back in 2016, 19%. Today, it's around, 26, 27%, something like that. Now, where could that trend over time? Well, it's an open question, but let me just throw out a few other data points. And I'll just sort of go up from the bottom. So the first little star above the group profit margin is the group incremental profit margin. So today, that's, as we just said, that's sort of in the low 30s. That tells us that all incremental revenues are coming in at sort of profit margins over just a little over 30%. So right there, that tells us that, okay, all else equal, if that is sustained, if those economics are sustained, then we should expect the total group margins to sort of trend towards the incremental margin over time. But we throw out a couple of other points as well, because remember, the leather goods segment is not only the largest, it's one of the fastest growing, and it's the highest incremental margin. So what it says is that in the fullness of time, that segment is really going to dominate the overall group. So through that lens, perhaps it's not even the group incremental margin that should tell us where this business is heading. Maybe it's just the leather goods incremental margin, which we know is 44%, so that's even higher. We can also look at a peer, which is Hermes, high-end sort of high-end luxury player, but specifically just in leather goods. So it's almost, think of it as a high-end leather goods pure play. Well, its group margin is north of 40, and its incremental margin is almost 50. So again, without trying to make a grand prediction here, these data points suggest that in the fullness of time, we think LVMH's group operating profit margins should trend upwards towards where those stars are. And it's just a question of when, in our view. Okay, and then the final leg to our thesis relates to undervaluation. And that is, we think Mr. Market is underestimating LVMH's long-term earnings power and therefore valuing today's earnings power too conservatively. So what I want to do now is take a look at where expectations are for LVMH. Let's start with the chart on the left. So group revenue growth. So it's expected to be around about 8% per annum, sort of on a normalized medium-term basis, by consensus Wall Street analysts. Now this is, if you recall, roughly in line with the high end of the Bain industry forecast. Okay. Interestingly, if you look at what we call the market implied, expectations for revenue growth. And here what we're talking about is this is the revenue growth that's embedded in the current stock price. So if you kind of undertake an analysis to reverse engineer what expectations are implied in today's stock price, we think you get to a group revenue growth of less than 5%, maybe it's 4% or something like that. And for the reasons we've already described, we think that's probably too low. Now, the chart on the right-hand side says, let's take a look at the expectations for group operating profit margins going forward. And you can see that consensus has them, roughly flat at around 27%. But again, just repeating the discussion that we had on the prior slide, we know that there are several what we would call long-term leading indicators for margins, which are represented by those stars up in the, between 40 and 50% level, which we think are a better guide. We think ultimately in the fullness of time, group margins will trend up towards those levels. And again, why is that? It's because the leather goods segment will dominate over time, and the leather goods segment comes in at such high incremental profit margins, and the reason for that is that growth is driven disproportionately by price and mix. And furthermore, it's worth noting for those who are interested that Mr. Market values Hermès' earnings power at more than double the multiple of LVMH. So you can see the chart showing is just very simply saying, take the enterprise value of each of these businesses and divide it by their EBIT. And LVMH is something like 17 times, whereas Hermès is up at around 40 times. Now, coming back to the argument that, well, over time, actually LVMH is going to be dominated by leather goods. Said another way, LVMH in the fullness of time will start to look a lot more like Hermès. I would argue it's already starting to look like Hermès, but even if you don't accept that argument, in the fullness of time, it will start to look a lot more like Hermès. So you might expect that, again, in the fullness of time, a fairer market multiple would be something a bit closer to whatever multiple Hermès is trading at. You can do other fun analyses with this as well. You can say, well, if you took the Hermès multiple and just applied it to the leather goods segment of LVMH, well, you're well over 100% of the total business value, saying that the market is applying negative value on every other segment, which doesn't really make sense as well. So whichever way you cut it, we think that this says that not only has the market, we think not only is the market being too conservative on long-term earnings power of this business, but we also think that the valuation multiple that's being applied is also probably too low. So look, let me wrap it all up now. We do view LVMH as an attractive long-term investment, and we think it's a great opportunity today. 3 core reasons. LVMH is a likely long-term winner in high-end luxury. It has these irreplaceable brands which are monopoly-like, huge barriers to entry, several other business advantages such as scale and network effects. LVMH is very well positioned in the long-term structural growth of high-end luxury. As we said, high-end luxury customers, the number of customers are not only growing at about 4% per year, but the wealth of each individual customer is growing in dollar terms in huge amounts. So we think that this could lead to an upside surprise in terms of the total dollar revenue that's derived from the high-end luxury space over time. And remember, these customers, these ultra-high net worth customers, are essentially immune to the economic cycle, which is a wonderful characteristic for LVMH to have. And then again, ultimately, we think the market is significantly undervaluing LVMH today for all the reasons I just described. Basically, earnings power, we think, being underestimated, and valuation multiple also being probably too low, given the quality and long-term growth prospects of this business. And so you put all that together, and we think that the current stock price is a great buying opportunity. And in the fullness of time, we think the stock price of LVMH will be much, much higher than where it is today.